What if I told you that you could trade profitably using just one indicator? No complicated setups, no confusion, no jumping between 10 different tools. Just one clean, powerful strategy, the same concept professional traders use. Simplified, and the best part, it has been backtested with 80% win rate. Let me show you exactly how it works. This strategy is very simple. We focus on just one indicator and ignore everything else. The 50 EMA. The 50 EMA 50-day exponential moving average is a line on the chart that shows the average price over the last 50 periods, but it gives more weight to recent prices, making it more responsive to current market movements. From a more advanced perspective, the EMA uses a smoothing factor that prioritizes recent data, allowing it to react faster than a simple moving average SMA. Because of this, traders use the 50 EMA as a dynamic support and resistance level. Price below it suggests a bearish trend, while price above it indicates a bullish trend, helping identify momentum, pullbacks, and trend continuation. Now, what we want to see is a chart where the price is trading below the 50 EMA, like in this example. The strategy begins when the price moves above the 50 EMA and a candle clearly closes above it, as shown here. At that point, the first condition of the strategy is fulfilled, a confirmed break above the 50 EMA. Now we wait for a pullback. However, we only consider a pullback to be valid if we see at least 2 consecutive candles in the opposite direction, meaning 2 red candles in a row after the price has broken above the EMA. Once that happens, we draw a horizontal line at the previous swing high before the pullback started. After those 2 red candles form, we wait for the price to break above that horizontal line. Keep in mind that the candle must close with its body above the line. When this condition is met, like in this example, we enter a buy trade. Even when everything looks perfect, no trade is ever guaranteed to be successful. That's why we must set a stop loss to manage our risk. To do this, we add one more tool to the strategy. In TradingView, go to the Indicators section and search for Chandelier Stop, then select the one created by Pip Charlie. Once it's applied, we place our stop loss at the chandelier stop level. Like in this example, it would be placed here. Then we set our take profit target at twice the distance of the stop loss, which would be at this level. So here we see the price has hit the take profit level as we predicted. Still, even if the setup appears flawless, it doesn't always mean it's a good trade. I have 2 main conditions that invalidate this setup. The first is when the pullback goes below the EMA. For example, imagine all the initial steps play out correctly. Price breaks above the EMA. Then we get a pullback with 2 consecutive candles and draw our horizontal line. But before the price can break that line, the pullback becomes too deep and drops below the EMA. If that happens, the trade is automatically invalid because the pullback is no longer clean. The second invalidation occurs when the breakout candle is significantly larger than normal. If the breakout candle is 3 to 4 times bigger than the average candle, there's a high probability that the move is not sustainable and the price may reverse. So setups like that should also be avoided. If you found this video helpful, make sure to like, subscribe, and turn on notifications so you don't miss any new videos. Thanks for watching.